Now let's look at a situation where I did do RSP contribution. So RSP contribution is comes before net income. It's this line here. It's line 2800 on your T1. The T1 is the tax return that you're actually. It's just the name of the tax return that you're actually submitting to the government. So let's say I had a let's say I made a contribution of $20,000. $20,000. Sorry. I'm just gonna have to put a limit here. Or actually, let me just override. Point of this exercise is just to show you an example. So there you go. Let's say I made a contribution of $20,000 to my RSP. So my total income is still 100,000, right? Which comes from my employment income, which comes from box 14 of my T4. And then I've got an RSP contribution of 10,000. So guess what? My net income now is 80,000. And if we scroll even lower, my taxable income is now 80,000. So I just reduced my taxable income from 100 to 80 because of my RSP contribution. So guess what? This 80 goes in this table here. And now instead of owing 17,700 like before, now I only owe 13,000 of taxes. So I saved, in this case, because of my salary, my RSP contribution, I basically saved that contribution amount times the highest bracket I was in. So I saved $20,000 times 20.5. That's how much I get to save with my RSP contribution because that's the bracket I was in. If my salary was 300,000 and I made a $20,000 contribution, then I'd be saving 20,000 times 33%. I would be saving in this bracket. And remember, this is just federally. We have provincially as well. There's provincial taxes as well. So I'm just talking about federally. I'm just trying to explain the concept of the income tax return. So because of my RSP contribution, I actually owed only 13,600. So I saved the difference from 17,700. I still have my basic. So I'm going to my non-refundable tax credits. I still have my basic personal amount of 14,398. I still have my employment amount because I was working, so 1287. I still have my unused tuition, if it's still valid, of 50,000, giving me total credits of 65,685, but it's multiplied by 15%. So I've got a total non-refundable credits of 9852. My taxes owing though is 13,639. So 13,639 minus 9852, which is my non-refundable credits, I'm left with 3786. 3786 is my federal tax that I'm supposed to pay. This is what I actually have to pay based on my situation. But guess what? I already paid 5,000 throughout the year of taxes in total income tax deducted over here. I already paid this throughout the year. It's on my T4. So you can see here, box 22. I already paid 5,000, but you're saying I'm supposed to pay only 3786. I already paid 5,000, so I paid too much, so I'm expecting a refund. So the difference between 5,000 and 3786 is the refund. I'm also going to add to it the 624 that it's going to deduct. So it's basically 3786 minus 624 of Quebec abatement. So I'm left with about 3,100, but I paid 5,000 already throughout the year. So basically I'm going to get a refund of 5,000 minus 3,100, which is about 1,900. Yeah, 1,800. There you go. So that's where my refund comes. So that's how the tax return works. You get a refund if you pay too much taxes, but you have to have paid taxes throughout the year to actually get a refund. It's called an income tax refund because it's a refund of taxes that you already paid. Now, there is a scenario where you can get a refund after doing your tax return, even if you didn't pay any taxes, and that's if you have refundable credits. So there's non-refundable tax credits which go against your taxes owing, and then there's refundable tax credits which you don't need taxes owing. You don't need an income to get a refund with refundable credits. So some example of refundable credits here is we could look at a few here. You've got the Canada Training Credit. You've got Canada Workers Benefit. You got a refundable medical expense supplement. You got the Air Quality Improvement Tax Credit. So they're not necessarily popular credits that everyone falls in, but probably the most common one would be the CWB, the Canada Workers Benefit. Depending on your income, and if you're not a full-time student, you might be eligible for the Canada Workers Benefit. Maybe the Canada Training Credit as well if you're a full-time student. You've got the eligible educator school supply tax credit as well. That would be a refundable tax credit. So if you're eligible for this credit and you didn't have income, you would be able to get this credit, and you would get a refund without actually having taxes owing. So this was just the federal return. Now, for in the example of Quebec, it's got its own return completely. It's a whole separate calculation. It's very similar, but it is a completely different return. But as you can see, it's got 100,000 of total income. The RSP counts as well. Now it's not here because I did an override on the T1, but if I entered the RSP correctly in the tax return, it would have flown correctly on the TP1. The TP1 is the Quebec tax return. So this time my net income is 78,000, federally my net income was 80,000. So as you can see, the calculations are different. Remember the non-refundable tax credit, the T1 here. Uh, CRA has a non-refundable tax credit of 1287 in the non-refundable tax credits, while Revenue Quebec puts it as a deduction over here at 1235. So it goes and reduces your net income. Instead of being a credit that goes against your taxes owing, it's actually a deduction towards your income and leaves you with less net income. Therefore, will leave you with less taxable income. So my taxable income is 78,765 instead of 80,000 compared federally.
So it's the same concept, same idea as the federal return, but Quebec has its own numbers, but same idea. So you can see it has a basic personal amount as well, but the basic personal amount for Quebec is higher. For 2022 was 16,143, while for CRA it's 14,398. But it's the same idea. It's a non-refundable tax credit. A percentage of that will deduct your taxes owing. So you can see here the non-refundable tax credit on my Quebec return, for example, is 16,000 times the 15%. So 2,421 is a non-refundable tax credit, which will go reduce my taxes owing. So here's the tax bracket for Quebec for 2022. You can see my taxable income is 70,000. So same idea. The first 46,000 gets taxed at 15%, and then anything between 46 and 92 gets taxed at 20%. So you can see the bracket is a bit higher. And then anything between 92 and 112,000 taxable income is 24%, and then 25% is the highest bracket, anything over 112. So you can see potentially if you're in the highest bracket, you could pay 25% to Quebec, and then CRA you could pay, the highest bracket is 33. So that's over 50% of your, remember, it's not 50% of your total income. It's 50% that of the amount that is over 221 in the case of CRA, and in the case of Quebec, it was 112. So as you can see, you cannot generalize over 200. You'll pay 50%. It's not a general rule. It's really progressive, and every province has its own tax brackets. But this is the calculation. You have a taxable income, and then the taxable income goes into a tax bracket, and then you end up with an amount of taxes that you owe. In this case, in this scenario here, on the Quebec side only, is 13,438, which is then reduced by 2,421 of non-refundable tax credits. So I owe 11,000 afterwards. And plus in Quebec, so this is a not a refundable tax credit, but the opposite. It's a tax that I have to pay. So depending on your income, you have to pay a premium under the Quebec Drug Insurance Plan if you don't have your own group insurance plan. So you have to pay it. That's an extra $710. I think Ontario has the same thing as well. So now I owe 11,726. But if I, and that's with my 20,000 of RSP. Now let's say I didn't have 20,000 of RSP, my taxable income would be 98,000 instead of 78. My non-refundable tax rate would still be 2,421, but this time my taxes owing based on the tax bracket over here is 17,685. So I'm only removing 2,000 from 17,685. So I'm left with 15,264 plus the $710 of the Quebec Drug Insurance Plan. So this is for Quebec, but what I'm trying to explain here is just the general concept. So let me just try to generalize it here. So you've got your total income. There's elements that get included in your total income, like your employment income, your business income, your rental income, your capital gains. So that is your total income line. And then you've got your net income line. Your net income, between your total income and net income, there are things that reduce your total income to give you your net income. For example, your RSP. So your net income might be lower than your total income if you've made RSP contributions. And then there are other elements that will come reduce your net income and give you your taxable income. And then that taxable income will then get taxed based on the brackets. So this falls in get this is what gets taxed based on the tax brackets. You're left with an amount that you owe, so tax owing based on that calculation. And then you've got non-refundable tax credits. This includes the basic personal amount, includes your tuition, includes your medical expenses. So you total up all your non-refundable tax credit, and CRA gives you a credit of 15%. So that will give you your total non-refundable tax credits. And then you've got your refundable tax credits, which will depend that not everyone's going to be eligible for refundable tax credits. There are some things that can give you a refund. But remember, the non-refundable tax credits, they lower your taxes owing. So you have to have a tax owing in order for your non-refundable to make a difference. Your refundables, you don't have to have a tax owing. You can get a refund with your refundable tax credits. An example of a refundable tax credit. Let's go to the form here. Just look at a few. So on the T1, if you go on the refundables, got your Canada Workers Benefit, your Canada Training Credit, your eligible educator supply, school supply tax credit. So you can get these refunds without actually having taxes owing. And then, of course, you've got your tax actually deducted during the year. So that's very important. So whatever amount taxes owing you have here, you're going to remove from it the non-refundable tax credit first, and then you're going to remove also the refundable tax credits, but you're also going to remove the tax that you actually ended up paying. So that's the difference. So that's why I was saying before, if you ended up paying too much throughout the year, more than your actual calculation being your taxes owing minus your non-refundable tax credits and your refundable tax credit, then you're going to get a refund. If not enough was deducted throughout the year, uh, so your taxes owing, the calculation of your taxes owing minus your non-refundable tax credits minus your refundable tax credits is more than the tax that was actually deducted throughout the year. Where do you get this amount? This will be on your box 22 on your T4. So that's if you're working, if you're employed. And then in that case, you would have a tax balance. If you're actually self-employed, you have your own business, you're actually not paying taxes, no taxes being deducted throughout the year. So this amount will be zero. So for sure, when you do your taxes, you're gonna owe a balance. You're not gonna get a refund because you're gonna have taxes owing. You're gonna have your non-refundable tax credit, but for sure you're gonna end up owing because you never paid anything throughout the year. So that's why, as self-employed, it's important to always put a bit of money on the side as you're making the money, because you're gonna have a tax balance for sure, because no one is deducting it for you. There's no employer deducting it for you automatically. So let's look at elements included in your total income. So total income, you've got your employment income, so that's the most common income line. You might have your pension benefits, your CPP, your disability benefits. Your employment insurance will be included in your total income on your T4E. Your EI, maternity and parental benefits. You've got your taxable amount of dividends. You've got your interest and other investment income as well. You've got your rental income. So your rental income is a separate form, and then your net profit will get included on your T1 return and get included in your total income. So for example, let's say you've got rents of, I don't know, 40,000 per year, but you've got expenses of 30,000. So that's a $10,000 net profit on the rental income. So 10,000 gets added to your total income, and then that 10,000 is included in your taxable income, of course, and then that taxable income gets taxed based on your bracket. So same idea with your capital gains. If you make a profit of, let's say, I don't know, 20,000, now 20,000 is not going to get added to your T1 return. It's not going to be included in your total income. Only half of that gets added to your total income. So it's going to be called taxable capital gains. So this line here, line 12,700, will be half of 20,000, so it will be $10,000, and then that $10,000 will get taxed based on your brackets. So when we say your capital gains are taxed at 50%, it's not 50%. You're not paying 50% tax on your capital gains. First of all, we take 50% of your profits, we include that in your total income, and then the 50% that's included, it gets taxed at your tax bracket. So depending on your tax bracket, you might not be taxed a lot. The minimum you'll be taxed is 15%. But let's say your only income was some capital gains of, let's say, 15,000. Well, then you're not going to pay any taxes because you have you've got a non-refundable tax credit of 14,398, and it is equivalent to 15%, which is the same as as the first bracket in the calculation of your taxes owing on your taxable income. So, for example, if I put zero here for my employment income, and I put 12,700 here, I put, let's say, 15,000. So now my total income is 15,000. I'm going to remove my RSP here. So now my net income is 15,000. My taxable income is 15,000. Based on the calculation of my brackets, I owe $2,250. But I've got a personal amount here of 14,398, and I get a 15% credit of that, which is, let me remove the tuition as well. So 15% of my 14,398, which is the basic personal amount that everyone gets, is 2,159. But I owe 2,250. That's the calculation of my taxes owing on my taxable income. But I've got 2,159 of non-refundable tax credit. So the difference, I'm left with $90. So I'd be paying I only owe $9,000. So not 9,000, but $90 of taxes. I'm just gonna remove my 5,000 here of the previous example here, which is on the T4. So remove my 5,000 of tax deducted already. So an example of making my only income is $15,000 of capital gains. I'm actually not going to be paying much taxes because of my basic personal amount, because of my non-refundable tax rate. So let's look at other examples of non-refundable tax credits. Actually, let's go back to total income. So yeah, so I've got my rental income, my capital gains, my EI, all this goes in my total income. My businesses are so self-employment income as well. I've got your gross and net, but only the net is what gets included in my total income. Social assistance payments and so on. So that gets included in my total income. And then I've got elements that reduce my total income to give me my net income. And most of the benefits or credits provided by the government are usually calculated based on the net income. So that net income line is very important. Your RSP, you've got the biggest one here is your RSP deduction. You've got your childcare expenses federally. You've got your disability support deduction. You've got your annual union professional or dues. You've got your carrying charges, interest expenses, and other expenses. You've got your employment expenses. So obviously during COVID, the $2 per day for working from home due to COVID, that was a deduction towards your total income. So that reduces your net income. So it was for example, in 2022, it was maximum $500. So that goes and reduces your net income, therefore reduces your taxable income. So you're saving taxes on $500. Now let's look at some elements in the non-refundable tax credit. So obviously the most common one is basic personal amount. Obviously the CPP and the QPP or the EI that you pay from your paycheck is also a non-refundable tax credit. So if I go to my T4 and I fill it out, let's say 100,000, let's say, I don't know, CPP, I don't know what the max is, let's say 3,500, or QPP 3,500, EI, let's say 500, and a bit of PPIP, and then I'll give myself, I don't know, $5,000 of tax deducted. So if I go back to the T1 and I look at my non-refundable tax credits, I have to remove the override that I have here. So there's my $100,000 of income. I'll remove the taxable capital gains as well. So I've got 100,000 of taxable income right over here. I owe 17,739. So let's look at my non-refundable. So I've got 500. I've got the 14,398, which is the basic personal amount. I've got $500 for employment insurance that was deducted from my paycheck. I've got the $55 for PPIP. I thought I would have the QPP or the CPP. I guess it's not a. I guess the QPP will be on the Quebec return. So let's just test it out and put an amount under CPP just to see if it goes on if it's a non-refundable tax credit, and I still don't see it. So if you're in Quebec, you have an equivalent tax slip, the RL1, the equivalent tax slip to the T4, and box E is where you would enter your taxes owing, or the taxes that were deducted throughout the year would be box E. Now, I'm not sure why this one's not calculating. Just to make sure, maybe I have to put my date of birth. So let's just put anything here, 1980 0101. Let's go back to my T1. There you go. So it was just missing my date of birth, so software wasn't calculating correctly. So yeah, as you can see, the CPP is a non-refundable. The CPP that I paid throughout my paycheck during the year is a non-refundable tax credit. So I've got my basic personal amount, I've got my CPP paid, I've got my EI paid. So basically, some of the deductions on my paycheck are non-refundable tax credits. I've got a basic Canada employment amount because I had employment, and so giving me a total of $19,000 of non-refundable tax credit times 15%, so 2896, which will go reduce my taxes owing of 17,651, which was the calculation that came out of this tax bracket table. So I'm left with 14,754. That's how much I owe. But guess what? I already paid 5,000 throughout the year. It was deducted from my paycheck. So please consider this, right? I owe 14,000. That's how much I should pay based on my situation. But I already paid 5,000, so remove that. And in the case of being a Quebec resident, I also have a Quebec abatement of 2434. So I'm going to take 14,000 minus 5,000 minus 2434, leaving me a difference of 7320, and that would be my balance owing taxes owing that I actually have to pay because I only $5,000 was deducted from my pay throughout the year. Now obviously if you're making 100K, your employer is going to deduct more than 5,000. Usually they deduct enough so you don't have to pay anything, but you end up getting a refund because some credits were not taken into consideration. Your employer doesn't know about all your credits, probably doesn't know you have tuition, depending what else. Maybe you have medical expenses as well. So that's why in most cases you will get a refund if you are employed. So let's say we put 25,000 was deducted throughout on your pay throughout the year, then you're going to be getting a refund because too much was deducted. You're getting a refund of 12,679 in this case. All right, so I hope this gives you a clearer picture on how taxes work. So if you have any questions, leave them in the comment section below. If you have any questions as well, if you have any video ideas regarding taxes, leave them in the comment section below as well so I can try my best to make a future video. All right, thanks for watching.